Hi, and thank you for taking a few minutes to learn a bit more about qualified charitable distributions, also commonly referred to as IRA charitable rollovers. My name is Jim Maslar, and I work in the Archdiocese of Indianapolis's Catholic Community Foundation, and I'll be happy to lead you through our short presentation on this planned giving vehicle. As you glance to the left of this first slide, you will see a quick overview of the quarterly presentations we've done thus far, beginning with our first in July of 2020 on a broad overview of planned giving. Each subsequent session was to then focus on exploring an individual type of planned gift or fund more deeply. To pull back the curtain a bit, we aimed to present the planned giving vehicles in an order beginning with the most accessible and common ones for you, the supporters of our Catholic parishes, schools, and agencies. In session 2, therefore, we looked more closely at the most common planned gift, bequests. In session 3, endowments, and in session 4, beneficiary designations of retirement accounts and life insurance policies. Today's topic is no exception and is right up there with the others in widespread accessibility and relevance, as well as ease of implementation. For the next few minutes, I want to briefly share what qualified charitable distributions, or QCDs, are, where they came from, and why they might make sense for a donor. As always, feel free to reach out to us with any questions, concerns, or ideas you might have along the way. The Catholic Community Foundation exists for that purpose. So to begin, what are qualified charitable distributions? A qualified charitable distribution, commonly called QCD for short, is a provision that allows taxpayers to make tax-free charitable gifts directly from their individual retirement accounts, or IRAs, to a qualified public charity, such as your favorite Catholic parish, school, or agency. Eligible for people 70 and a half or older, QCDs provide unique tax benefits to those who are 72 years or older. More on that in a moment. QCDs are a relatively newer and now more accessible planned giving vehicle that could positively impact the efforts, programs, or funds most dear to you at your favorite Catholic parish, school, or agency. It is a gift for all seasons and can impact the present, the intermediate, and the future. Whether you're Sunday tithing, a contribution to a capital campaign, or adding to a ministry's endowment fund, qualified charitable distributions have been attracting a growing number of donors. QCD gifts rose 74% nationally in the latest study in 2019. And over the last 5 years, our office has also seen a great increase of 125% growth each year in the number of QCD gifts. As we'll get to in a bit, QCDs provide unique tax and financial planning incentives to donors who are retired. You might be wondering what these 3 pictures are doing on the same page. Well, the qualified charitable distribution provision was temporarily codified in the 2006 Pension Protection Act, being signed there by President Bush. However, just as our music legend friend here was known for a while, primarily by reference to his former name, our planned gift today is still often referred to or known by its common colloquial name. And so you may know it by the more intuitive IRA charitable rollover. Because the original 2006 Act and the IRS in its tax code uses qualified charitable distribution instead of IRA charitable rollover, you'll find that institutions more and more are using QCD. But just know that a QCD was the gift formerly known as IRA charitable rollover. Okay, that was a look at the basic definition of a QCD, but we have found that many of our donors and even some of their financial advisors are not fully clear what QCDs are or how they work or if they qualify. So we thought it would be helpful to give a brief history and context about how they fit into the charitable landscape and a potential option for your stewardship. A quick history. For much of American history, workers relied upon their employers to provide for them in life after retirement, often taking the form of a monthly check as part of a pension plan. This format was, and still is, effective for many. However, its potential weaknesses for both the company and the worker were a growing concern in the 20th century, with a notorious display in 1963 at Studebaker Corporation in South Bend. When the auto manufacturer closed its plant that year, Studebaker, after years of financial mismanagement, could not afford to provide all employees with their pension benefits. Thousands of employees received nothing, and several thousand more received only 15% of their plan's value. This became a symbolic case for a national push for pension reform. It was out of this reform in the 1970s and early 80s that individual retirement accounts appear as a protection for workers' retirement benefits, an incentive to save for retirement through built-in tax incentives. The 1974 ERISA Act originally created these IRAs for employees of businesses unable to provide pension plans. But in 1981, this was expanded to include all workers, no matter what their employer offered. These newly crafted IRAs could be housed or administered by a custodian financial institution of the person's choosing, such as a bank, a brokerage firm, or an insurance company. And they grew tax-free in the meantime through a variety of investments. Big business took notice, however, as many companies liked the idea of not having to assume the risk, responsibility, and costs of managing pension plans. Executives from large corporations like Kodak lobbied Congress for similar provisions that they could offer their employees, and thus was born the 401k in the 1978 Revenue Act. Connecting the two, upon retirement or a job change, a person can roll their 401k funds into an IRA, which is untethered to a particular employer. So what does this mean? That from the 1970s to today, there has been a major shift in Americans' retirement assets from being housed in pension plans to IRAs and similar plans, which impacts greatly where folks' assets reside and how they might give. So what does this have to do with your personal charitable giving at your parish, your favorite Catholic school, or the agency you volunteer at? IRAs, 401ks, and their nonprofit and government equivalents, as you'll see there, 403bs and 457s, and thrift saving plans, respectively, are for many Americans a sizable asset to steward. As a country, as of 2019, 11 trillion is held in IRAs alone. And those trillions of dollars you see held in 401ks, 403bs, and below can be rolled into an IRA account upon a worker's retirement or change of job, as referenced earlier. The point, the time is particularly ripe to increase our supporters' awareness of how their retirement funds can become a part of their stewardship planning, whether now or in the future. And qualified charitable distributions are an easy and attractive way for donors to do just that. You might ask, how so? Well, the government has allowed this retirement money to grow tax-free for years, and now they want to get their tax money from it. Hence, once you turn 72, the IRS calculates a minimum percentage you must take out of your retirement account to be included in your income for that year, and thus to be taxed. This RMD, or required minimum distribution age, was recently moved from 70.5 to 72 with the Secure Act of 2019. The percentage you must withdraw is based on your age that year in the IRS's life expectancy tables. And you don't want to ignore the requirement either, as the penalty is 50% of the RMD amount. Here's an example to illustrate this. Mr. Bond is 75 years old and has a traditional IRA valued at $100,000 on December 31st, 2020. At some point in 2021, Mr. Bond is required to receive distributions from this IRA of at least $4,367, which will then be taxed as income. If Mr. Bond is a single filer in the 22% tax bracket, that could be $961. As you can see, Mr. Bond is not thrilled about this. And remember, if Mr. Bond chooses to ignore the IRS's RMD, he'll be penalized an additional $2,183. Luckily, Mr. Bond recently read his parish's newsletter, which shared information on QCD giving, which was previously unknown to him. Discovering not only that QCD was an option for him this year, but that in 2015, Congress permanently enshrined this charitable option for required minimum distributions that could be used for certain plans, including his traditional IRA, therefore making the QCD provision permanent. And so you might ask, how does one make a QCD? The process simply includes the individual instructing their IRA custodian to directly send a check to a chosen public charity, and that they would like it to qualify as a QCD. An individual can make QCDs up to $100,000 per year. And if they file taxes jointly with their spouse, they can also make a QCD from the spouse's own IRA within the same year for up to $100,000. This QCD provision presents an additional array of potential benefits to a donor we'll now look at. Number one, it is an easy and free way to charitably give. The process for making a QCD is uncomplicated and requires no setting up of new funds or accounts, no extensive paperwork or fees, and takes minimal time to implement, usually a simple contact of the IRA custodian. Number two, as we've discussed, a QCD can qualify to satisfy some or all of a person's required minimum distribution that year. We have heard the sentiment in one form or another, I have to take the money out one way or another, and QCDs can be especially attractive for those who don't need that extra income. Also, for a person already planning on donating to their parish, school, or agency that year, gifting first through QCDs often makes the most tax sense for retired donors for this reason and the ones below. Number three, a QCD is not counted towards a donor's income and therefore lowers what would have been their gross taxable income that year. For some donors, this could have the ripple effect of lowering their Social Security benefits tax and or their Medicare premium rate. Number four, with the new higher standard deduction, many donors who used to itemize their charitable giving don't anymore. QCDs provide a way to give that provides tax benefits even if someone takes the standard deduction. And number five, QCDs can allow a person to give a gift of a greater amount, especially if a person is already planning on donating. QCDs can offer a way to give more and to give more tax-free, i.e., 100% of the QCD goes to the charity. I have often heard a version of the following motivating sentiment from donors. Quote, less money to the government and more to the church. So to close, I'd like to revisit our illustration of Mr. Bond. After reading about QCDs, Mr. Bond decides he'd rather the whole amount of his required minimum distribution go to his favorite Catholic ministries, his parish, his high school alma mater, and Holy Family Shelter, where he volunteers twice a month. He contacts his IRA custodian at Charles Schwab and requests they send a $4,367 QCD check to the Archdiocese of Indianapolis, who distributes a full 1/3 to each entity per Mr. Bond's request. Mr. Bond enjoys still benefiting from charitable giving despite not itemizing on his tax return. He satisfies his required minimum distribution for the year, and with a lower adjusted gross income, keeps his Medicare premium at the standard rate. As you can see, Mr. Bond is very happy and wants to do it again next year. That concludes our brief presentation on qualified charitable distributions. For more information or to see how to take next steps to make a QCD, call or email us anytime or visit our website at www.archindy.org/CCF, where you'll see an IRA gifts button at the top. As you continue to consider your own expressions of stewardship and generosity, whether with qualified charitable distributions or any other plan giving vehicles or strategies, please know that we would be happy to serve you. God bless, and thank you for listening.